Ever wondered how crypto investors and traders navigate the complex world of cryptocurrencies with those colorful charts? How do they predict price movements and determine when to buy, sell, or trade? Let's walk through the basics of how to read cryptocurrency charts, including candlestick charts and identifying trends. So let's dive in. Crypto charts are like maps of the cryptocurrency market, showing price movements over time. They are extremely important tools for both traders and investors using technical analysis, known as TA. Charts typically have two main axes. Across the bottom is the x-axis. This represents time, with each interval showing a specific time period, like hours, days, or weeks. Running vertically along the side is the y-axis. This represents price, with each unit indicating the value of the cryptocurrency, commonly paired against the US dollar. Candlestick charts are the most common type of cryptocurrency chart and provide detailed insights into price action. Each candlestick represents a specific time period, such as an hour, day, or week. Now let's break down the anatomy of the candlestick. The body is the rectangular part of the candlestick, which represents the price range between the opening and closing prices during that time period. The wicks are the thin lines above and below the body, which indicate the highest and lowest prices reached during that time period. As for the color, if the price closed higher than it opened, the candlestick would typically be green. Alternatively, if the price closed lower than it opened, the candlestick would typically be red. Now let's move on to spotting trends. Trends are crucial for understanding or anticipating market direction. Here are the three main types of trends. An uptrend occurs when the price of a cryptocurrency is consistently rising over time, forming higher highs and higher lows. This indicates a bullish momentum. Imagine looking at a chart and seeing a series of candlesticks with increasing highs and lows over time. This signals an uptrend, indicating that the price is likely to continue rising. Conversely, a downtrend happens when the price is consistently falling, forming lower highs and lower lows. This signals a bearish sentiment. Just imagine analyzing a chart and noticing a pattern of decreasing highs and lows over a selected time period. This suggests a downtrend, indicating that the price is likely to continue falling. And then we have a sideways trend. This occurs when the price moves within a relatively confined range, neither rising nor falling significantly. This crabbish or sideways movement is also known within the financial space as consolidation. Think of a chart with candlesticks oscillating within a tight price range over a period of time, generally confined within a level of support at the bottom and a level of resistance at the top. And there you have it. The basics of reading cryptocurrency charts. By understanding candlestick charts and identifying the various trend types, you'll be better equipped to navigate the cryptocurrency market. Just remember to practice analyzing different charts and patterns to refine your skills and understanding. Don't forget to hit the like and subscribe buttons for more crypto content. Happy studying, trading, and investing, and I'll catch you in the next one.